where do you actually invest your money? How do you invest your money? And there's a couple of different categories of things that you want to pay attention to. Number one is, are you going to be investing your money into cash flow producing assets? Number two, are you investing your money passively or actively? Some investments, like your rental properties, like stocks that pay out dividends, pay out cash flow. Other investments don't. Like you can go out and invest in real estate and hope to flip it in 6 months to 3 years or 5 years or whatever and make a huge profit. Same in the stock market. You can go out and buy stocks with the goal of trying to sell the stock for a huge profit in the future, or you can buy stocks that are going to pay you for doing nothing except owning the stock. This is called a dividend. A dividend is when a company is going to pay you every 3 months, generally every quarter, and they're going to give you a check or deposit this money directly into your stock brokerage account for doing nothing except owning the stock. Now, what you have to understand about cash flow investing is you're not going to get rich by investing your money into cash flow, especially in the short term. Cash flow investing is a long-term game where you're going to have to constantly keep buying more of these cash flow producing assets and do this for a long enough period of time. That way now you can build a significant stream of cash flow, but it's not going to happen today. It's not going to happen next year. It's not going to happen the year after that, but you're going to have to stay consistent if that's what you want. Cash flow investing to build real wealth takes time and it takes commitment, and it takes you consistently putting more dollars into it. A lot of people think that, if I buy some cash flow, I'm going to be rich. You don't get rich by buying cash flow. You have to make the money first, and then you use this money to generate cash flow. You got to get rich, and then you use this money to buy the cash flow. When you put enough riches into these cash flow producing assets, you're going to get more cash flow back. The general rule of thumb of what you're going to see from real estate to stocks is somewhere between 2 to 7% cash flow. That is kind of your general range. Sometimes a little bit less, potentially sometimes more, but generally $2 to $7 worth of cash flow, which means for every $100 you invest, you're going to get $2 to $7 a year in cash flow. Again, it's not going to seem like a lot of money, but now when you change that up to investing $100 a week, every week, over 10 years, now you can start to see where the cash flow starts to grow, because then when you get that cash flow, you can also reinvest that cash flow to earn more cash flow. So now you're slapping $100 every week to buy more cash flow. And then when you get that cash flow check, instead of taking that and using it to go out and buy something nice, you take that money and you use it to buy more cash flow. That way every 3 months, you're buying more cash flow because you're just throwing more money into this machine that's printing you cash. That is how you build wealth, by investing for cash flow. The alternative is, well, now you're not investing for cash flow. You are buying something for, say, $100 and you want this to go up to $200. Again, that's okay. It's just an alternative way to get paid. And this is where now you have to be able to analyze your investments. You have to know how to invest your money, and you have to know the different places where you can invest. Again, the two most well-known places where you can invest is in the stock market and into real estate. Now, if you want to get started in real estate by owning physical properties, it's going to take more money, it's going to take more time, it's going to take more resources, it's going to take more risk. There are alternative ways for you to invest in real estate by investing in funds online. I have some of these resources in the description. If you want to see some of the companies that I work with, they are affiliate companies of mine. But it is a way for you to get exposure to real estate. Real estate generally is going to take more work, more time, more risk, and more money. With the stock market, you don't need as much time, risk, or money, because you can just throw your money into the market. And this is where you have to decide now if you want to be an active investor versus a passive investor, or a hybrid of both. And if you ask me, the vast majority of America, 90 to 95%, maybe even 98% of Americans should be passive investors, but everybody gets attracted to the idea of being an active investor. And what that means is, when you try to put your money in the stock market, most people think you have to find the next Amazon or the next Google or maybe the next Apple if you want to get rich. But that's not how the vast majority of people will get rich, because when you play that game of trying to find the next hot stock, most of the time, the vast majority of the time, you're going to lose. And most people don't have the psychology to know how to manage their investments, when to buy, when to sell, and when to hold. And most people don't know how to analyze their investments. Maybe you find some cool companies that you want to invest in, but how do you analyze the financials? How do you know if the cash flow is growing? How do you know if the profits are growing? How do you know if they're using their cash the right way? How do you know if the executives who are running the company are doing good things? How do you know how strong the moat is, meaning how hard it is for another competitor to come in and take their spot? How do you know if they're using their cash flow the right way? How do you know if they have good assets and liabilities on their balance sheets? If that sounds interesting to you, which, unless you're a money nerd, that's not going to sound very interesting to you. You should be looking for something that's going to appeal to the interest and the time that you have. Being an active investor is difficult. This is what Warren Buffett spends his days doing. He's an active investor. He loves researching companies. He loves studying their financials. He loves studying the products. He loves studying the executives at their company. He loves studying the innovation. He loves studying the branding of the company. That's what he's doing. When you're investing in the stock market, you're literally buying companies. When you buy one share of Amazon, you become one of the owners of Amazon. And if you don't want to treat it like that, then you're essentially gambling. Sure, you can make some money. You might find a cool company that you like before it pops off, but you might not. And you might not have any way of knowing if your company is a good investment or not. If that's something you want to do, you want to invest in individual companies, fine, but just understand the risk. And the more research you do, the more you learn, the more time you spend, and the more money you spend learning how to do it, the better you're going to do. But again, this is long-term investing. I'm not talking about trading. I'm talking about long-term investing. If you want to invest in individual companies, understand that that is a real skill if you want to succeed. The alternative is being a passive investor. A passive investor is now, instead of you trying to find the next hot Amazon or the next hot Apple, now what you're doing is you're just investing your money into the stock market. You're investing your money into America. And if America grows and our stock market grows, you make money. And now you don't really have to try to find the best time to buy. You don't have to find the best price. All you're going to do is set up a system where now every time you get paid, you're just going to throw money into the market. And this can be completely passive. You don't have to spend any time doing this besides finding the right funds to invest in the first place. Then you just automate it, set it, and forget it. And so it's much less time, much less risk, because now if you invest in, there are funds, for example, that will give you exposure to the entire stock market. For example, there is an ETF, an exchange traded fund called VTI. It trades just like any other stock on the stock market. But when you buy one share of VTI, you are in essence buying the total stock market, which means now you're just getting exposure to America and the stock market. Now you have hundreds or thousands of companies that you're investing in. And so if one company goes bankrupt, it doesn't bankrupt you. It just gets kicked out, and now another company might come in. It gets balanced out by the losers. If one company goes really big, yeah, that's going to benefit you, but it's also going to be balanced out by some of the losers. So these funds, like ETFs, you can also look at index funds. Some mutual funds might also work. These funds are giving you exposure to baskets or groups of stocks, so that way you don't have to find the perfect company. But the key to win in this type of passive investing game is you got to just keep throwing money into the ETFs every week, every 2 weeks, every month. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.